Hi friends, welcome to Adda 24/7. We are in the Scholar series for BFM. Here we are covering all the important theory, numericals, objective questions, case studies. So follow the series completely till the end and also follow all the parts of the series. Follow it daily. Okay, let's start. First one, RAROC stands for, what is RAROC? Risk Associated Return on Capital. Risk Adjusted Return on Capital. Revenue Adjusted Return on Capital. Risk Associated Reward on Capital. So what is RAROC? Risk Associated Return on Capital. Risk Adjusted Return on Capital. What is it? Is it associated? Is it adjusted or revenue adjusted? Risk again associated reward on capital. Is it a reward? I'll give a few explanations about this. Firstly, before knowing RAROC, you must know what is ROC. So here I'll explain it over here. We are having space over here. ROC. What is ROC? A return on capital. Return on capital. Do you know something about this ROC? What I have invested and what am I getting in returns? That's it. Suppose if I have invested 1 lakh rupees and per year I am getting, let's say, 7,000 rupees from it. So my ROC is what? My ROC is 7%. 7,000 upon 1 lakh into 100. So that is my share. I have invested 1 lakh. Now I'll explain you RAROC. Invested 1 lakh. Invested 1 lakh. Okay. Returns per annum. Now look at this. Per annum. Returns per annum. Per year we call it. Okay. Per year equals to, let me make it 9,000. So what is my ROC then? My ROC equals to 9,000 upon 1 lakh, right, invested into 100. So it is 9%. But what is RAROC then? RAROC means risk adjusted. What is risk adjusted? Suppose, look at it. Suppose if I invest this in some shares and there is a chance that the share might go down. Now to adjust these shares, I have taken some insurance, or I have made some riskier bet. Let's say shares, or I have invested in something else which may go down also. There is the risk of going down. So to adjust that, I purchased the insurance. Now the cost of that insurance is, let's say, rupees 2,000 insurance I have purchased to safeguard against my investment. Insurance. The cost of this insurance is, let's say, 2,000. Okay. So what is my net returns now? This 2,000 I am giving annually. I am getting annually 9,000. So my RAROC, risk adjusted return on capital, becomes 9 minus 2 minus 2,000 upon 1 lakh. Okay. And that into that 100. So now it becomes 7%. Okay. So that is RAROC. And the full form of this is risk adjusted return on capital. Okay. Got it? There are two separate words. One is RAROC, RAROC. That is RAROC. And second word is similar one, RORAC. These two are separate words. Remember, risk adjusted return on capital and return on risk adjusted capital. These two are separate words. In exam, if they ask you RORAC, then it is return on, see, this wordings are same. Only the order changes. Return on risk adjusted capital and risk adjusted return on capital. Understand this very clearly. Okay. Okay, now shall we move on? Yeah. In the process of risk management, which out of the following is correct order? Means Which is the correct order in risk management? Quantification, identification, control, and mitigation. Now all the sequences are given. You can read this. Read it and tell me, everyone. Yeah. Which one? Which one? Everyone, read it, read it. Identification, quantification, mitigation, control. Identification, quantification, control, mitigation. And last one is this: identification, quanti, and control. So what is the answer? The correct sequence is, okay, what do we do? Whenever you see any problem, first you identify the problem. So first is identification. So either B or C now. Okay, so A and B are out. So A and D, sorry, A and D are out. This is out and D is out. So first I'll identify the problem. Afterwards what? Now look at this: quantification, mitigation, and control. What is mitigation? Mitigation means minimizing the risk. Minimize. Okay. How will I minimize? Before minimizing, I must know what is the quantity of that risk. Right? When do you minimize any problem? Whenever you know how big that problem is. So quantification is the second step. So quantification is also correct. So identification, quantification. Now mitigation and control. Now do you control first and then mitigate, or do you mitigate first? Mitigate means minimizing and then control. So the correct sequence over here becomes this. First you mitigate, then control. So identification, quantification, mitigation, and control. Okay, this is a sequence always. Now what is mitigation? You will ask me, sir, what is mitigation? Quantification means we know. What is mitigation? Reduction. The same example which I gave you just now about that insurance means I have invested in some riskier project. Let's say riskier, not only shares, because we don't take insurance against shares. We should take actually for large investments. But let's say I have invested in some big factory. The return from that factory is, let's say, as I gave you that example, 9,000 per 1 lakh. Now the insurance for that factory is 2,000. So then that becomes my mitigation part. Okay, got it? Financial risk is the uncertainty that results in, here. Firstly, what is risk? Financial risk. Risk means anything which is uncertain. There are two things to risk always. One is uncertainty, and second point is for risk is, that is given in the answer. Now that's what you have to find out. Uncertainty first, that results in adverse market report of the business, adverse variation of profitability or outright losses, adverse movement of capital of the bank, and all of the above. Now look at this, all of the above. That can also be one answer. Huh? Yeah. Think over it. All of the above can also be one answer. Adverse. So how many of you feel answer is D, all of the above? Let me see in the comment section. How many of you are typing in D? I'll wait for 20 seconds. Let's see. Okay. So let me see how many of you have typed D as an answer. The answer is not D actually. The answer is only related to profit. Okay. So variation in profit or outright losses. This is the answer for this question. That results in outright losses. Here, financial risk has 2 points always. One is uncertainty, and it should result in less income or negative income. Okay, only then we'll consider it as a risk. How much profit am I earning? Suppose if I'm earning 1 lakh rupees as my profit, if my profit decreases from 1 lakh to 70,000, then it's a risk. Or this 1 lakh profit decreases to minus 1 lakh, means losses of 1 lakh, then also it's a risk. If my profit of 1 lakh in any project increases to 2 lakh, so is it a risk? No, it's not a risk, right? Got it? So the answer is financial risk is the uncertainty that results in adverse variation of profitability and outright losses. A person wants to make an investment of rupees 50,000 in one of the following for 5 years. Out of these, which one should be preferred? Solely on the basis of risk. Solely on the basis of risk. Look at this. If the return is 10% in all the cases. Now, I am having 50,000. I have to invest it for 5 years. Okay, or you are having 50,000, you have to invest it for 5 years. Let's say you are the case, you are the one who is having 50,000, want to invest it for 5 years. All the investments are giving you 10% return. So what will you invest in? FDR issued by NBFC, a bank FDR, a long-term government security. All are equal since the return is same. Very important. Which one will you invest? Let me see. FDR issued by NBFC. I know you all are bankers because being in the bank, you all will always prefer what? Bank. Oh, bank is the safest institution. Bank. Right? NBFC, no, because many of the bankers have unknowingly we have considered NBFCs as our enemies. Oh, these NBFCs are going ahead of us, right? So many of us, no NBFC. Now here your emotions are getting attached to the answer. I don't like NBFCs. I like my bank. Or I don't like my bank. Then also, that can also be the one point. But what is the correct answer as per the risk factor? Which is the safest investment? NBFC, bank FDR or government security? The correct answer is what? Correct. The correct answer is long-term government security. Okay. Long-term government security. Always remember this, because government is always having the sovereign rating. Sovereign rating. Sovereign. In any country. Sovereign rating means 0% rating. 0% risk. All others have risk. But based on the risk percentage or risk factor, we should always invest in government security. Okay, but depends which government it is. Now government security means if you say, sir, if I invest in bonds of Pakistan, then no, Pakistan government security means your own country's government security. That's what is the meaning, not any other countries. Okay, so it depends on the government also. Suppose if American treasury bonds, if somebody wants to invest, many of the institutions in India are investing in US treasury bonds. They are allowed because the rating is sovereign. But if tomorrow Sri Lankan government issues the bonds, will you invest in that? No. You have to check the government's risk also. What is the level of that government? Okay. So specifically talking from the Indian perspective, here we mean Indian government only. So even in Pakistan, okay, understand this. If this question would have been in Sri Lanka or in Pakistan, then also this answer would have been correct. Why? Because for them, their government security is government is sovereign. Okay, you won't invest in them, but many of those persons there can invest, because if government is not secure for them, how can the NBFC and FDR be, bank FDR be secure in that case, right? So that's why a long-term government security will always have the sovereign risk or 0% risk. Okay, got it, everyone? What are the types of government bonds? Tell me, everyone. Government bonds issues bonds in two types. Okay, government, it issues bonds in two types. One is less than 1 year or 364 days. That's a specific answer. 364 days. And second is greater than or equal to 364 In fact, less than or equal to 364 days. This is greater than 364 days. Means greater than 1 year we call it generally. These are called as T-bills. And these are called as dated bonds. Dated. Okay, dated bonds or dated securities bonds. Okay. There is a third category. Means nowadays it has been made. It is less than 91 days. These are called as CMBs. CMB, cash management bills. Okay. So these are the three categories of government bond generally. Okay. Which of the following is correct statement? Lower the risk premium. Lower the risk, higher the risk premium. Lower the risk, higher the risk, lower the risk premium. And the second one, lower the risk, no risk premium. Which of them is correct? Okay, you guys tell me. Suppose if you buy insurance at the age of, let's say 20, 21. Okay. You buy insurance at the age of 21. Or you buy insurance at the age of 45. Okay. Which premium will be higher? This will have low premium insurance. I'll write it insurance over here. Insurance. Same insurance over here. I'm buying insurance at 21 age or 45 age. Which insurance premium will be higher? Of course, this will be higher, right? This high. This will be low. Why? Because lower the risk premium. Why the lower the risk? After the age of 40, the insurance premium increases because the risk of various diseases increases. Okay, so lower the risk premium. Now the answer can be, many of you might be thinking about A or you might be thinking about D also. Lower the risk, no risk premium. So the answer is not no risk premium, it is this A, low risk premium. Because in that case, if no risk premium, then the insurance premium for this person of 21 age should be 0. They should give this insurance at free. Isn't it? No risk premium, right? So that's why it can't be no risk premium, it will be lower risk premium. Okay. Management of risk within a bank is a major concern of top management, senior management, middle management, operational management. Which, yes. Management of risk is a major concern of which management? Top, senior, middle, and operational. Do you know the sequence of this risk management in banking? Then you'll understand. First, top level is what? Board of directors. Afterwards comes what? Who can tell me? Afterwards, below this, it is RMCB, Risk Management Committee to Board. After RMCB, there are 3 committees then. Okay, ALCO. You might have heard this name ALCO many times, right? Then CRMC. And last one is ORMC. Right? This is the sequence. Then below this, there are subgroups or support groups, we call it. Support groups to this. Below this. This is the overall framework. Okay? Support groups to all these 3. So this is the framework. So who is at the top? The main person is what? Board of directors or top management. Okay? So it is, answer is this, top management. Management of risk within a bank is a major concern of top management. Okay? Actually, the correct answer is board of directors, but you have to choose within the given answers. If there would have been the answer of board of directors over here, you would have selected board of directors. Okay? Got it? Clear everyone? Next one. Management of risk begins with mitigation of risk, identification of risk, controlling of risk, and quantification of risk. So it begins with what? Just now I gave you this 4 sequence, we saw it now. It was this. We'll move fast on this. Identification, right? Begins with. Usually the risk management organization in a bank consists of board of directors. Look at this. Same I gave you, right? Board of directors, RMCB, Risk Management Committee to Board, Senior Level Executives Committee, Risk Management Support Group. an operational risk management team. So it consists of what? Risk management organization in bank consists of. So it consists of what? There is something remaining in this, right? There should be options over here. Yeah. Risk management organization in the bank consists of, yes, there is something remaining over here. Yep. It should be like this. See here, the sequence I'll give you. Okay, I'll type this sequence over here for you. Okay. Let me change this option a bit. Okay, I'll give you one sequence over here. Seventh one is, so let me write this A as only 1, 2, 3 and 3 senior management, and fourth is risk management support group. Yes, fourth. And fifth one is operational risk management team. So this fifth, operational risk management team. Yeah, let me write this fifth one also, or let me, yeah, fifth one. And B is what? B I'll make it only 4, these 4. Okay, not fifth one. C I'll make something different. C means only 3 I'll make it. Okay, and D I'll make it only 2. So now you tell me 1, 2, 3, 4, 5. Then B is 1, 2, 3, 4 only. Then this 1, 2, 3, and last one is 1 and 2. So what do you think should be the answer over here? Okay, it should be, again I am seeing the answer all of you are typing is this A, all of the above. No, answer is not all of the above. All of the above is not always the right answer. It can be a trap also. The correct answer is B. Okay, B. Why? Because only up to 4 elements it is considered: board of directors, risk management committee to board, senior level executives committee, and risk management support groups. Now this operational risk management team, when we say, this is a part of 4 only. Risk management support group. Risk management support groups will be of 3 types. One is credit risk management support group, operational risk management support group, and last one will be that market risk management support group. So this operational risk management team or group will be a part of this 4 only. You need not mention it separately. So that's why the answer is B. What? 1, 2, 3 and 4. Okay, so that is the answer. Got it, everyone? That should be the answer. Remember, operational risk management team need not be mentioned separately in this sequence. Just now I gave you this now. See this. ALCO, CRMC, ORMC is a part of the senior level or the support group. Okay. Which of the following has the responsibility for implementation of risk and business policies simultaneously in a consistent manner and decides RMCB, senior level executives committee and risk management support groups? Who has the responsibility for implementation of risk? The answer lies in this first line itself, implementation of risk. That's it. There lies the answer. Board of Directors, risk, RMCB, senior level executives committee, or RMSB, SGU, you call it. What is the answer? Everyone is typing board of directors. No, board of directors is not the answer. Why? Implementation, board, see the sequence. Implementation is a job of senior level executive committee. Executive, what is the meaning of executive? Executive is there for implementation. Manager, senior manager, vice president, all these persons are for implementation. Board of directors will never implement the things. They will see to it that they are implemented. Say this. See, look at this sequence again. Board of directors, RMCB and ALCO CRH. This is a implementation level. This from here. This is a policy making level. Policy making. This is policy making. Okay, and this is implementation part, lower level. Okay, so always remember this implementation. Got it? So everyone got his answer. Risk management, this RMCB and both these A and B are for policy making, and RMCB also sees to it that it is implemented, but it doesn't work personally. Okay, got the answer everyone? Shall we move on now? Here, yeah. This all remaining things, I think so we did it already. Yeah. Okay. So got it everyone? Senior level executives committee. Type yes in the comment section if you have understood up till now. Chalo. Now before going, everyone kindly join the victory batch for June 24. All the numericals, objective questions, case studies covered. All the compulsory subjects covered. You can join the CAIIB Mahapack 2.0 also. In this Mahapack, you'll be getting multiple batches per subject. Plus, you get ebooks, test series in both of them. So join immediately. Okay. Now, how to join it? Let me show you. Go to Adda 24/7. How to go to Adda 20? I'll always suggest you to go through the app. In the app, you get 1% extra using the coin systems. See this. Go to Adda 24/7. Right. Then click on JAIIB and CAIIB. Look at this. Click on JAIIB and CAIIB here. Then click on CAIIB June 24. Done. Look at this. Yeah, net. Click on June 24. See this. Then you will see this victory batch. Okay, for CAIIB. Victory batch. Click on this victory batch. Let this net come back. Okay. Click on this victory batch. Okay. English medium. Now look at the discounts. 77% off. Click on buy now. I'll give you more discounts. Put the code Y432. Click on apply. Look at this. 79% off you are getting discount. Plus, if you use the app, you'll be getting 1% extra. Okay. So join it ASAP. Very important batch because it is at the right time. Okay. I'll be back tomorrow with another series. Till then, keep studying. Okay.